5 ETFs are absolutely torching the scoreboard in 2026, and if you chase them the wrong way, your portfolio could go from hero to sad sandwich by lunch. Today, I'm going to show you which ETFs are leading, why they are up so much, and how to think about them without turning your retirement account into a reality show. If you are trying to build wealth in your 30s, 40s, 50s, or beyond, this matters because the best performer on a leaderboard is not always the best investment for your life. One wrong move with a super hot ETF can feel exciting for about 3 minutes, and then emotionally damaging for 3/4. Here is the plan. First, I will show you the 5 top-performing ETFs as of June 8th, 2026. Then, I will break down what each one actually owns, because ticker symbols should not feel like encrypted messages from the future. After that, I will show you what the data says about concentration risk, commodity futures, and momentum investing. Finally, I will give you a simple framework so you can decide whether these belong in your portfolio, your watch list, or the witness protection program. Disclaimer: this content is for educational and entertainment purposes only and is not financial, legal, or tax advice. Investing involves risk, including loss of principal. Consider your goals, time horizon, and risk tolerance before investing. Speak with a certified financial advisor to help you develop a customized plan. Now let's get back to learning. Let's start with the leaderboard. As of June 8th, 2026, the top performers on your list are BWET, up 411%, DECO, up 79.6%, USO, up 77.2%, UGA, up 75.8%, and PTF, up 77.1%. That is not a normal list. That is a list that looks like the market drank 3 espressos and started speaking in all caps. BWET is the breakwave tanker shipping ETF, and it is tied to tanker freight futures, not plain old oil stocks. That matters because it is effectively a bet on the price of moving crude oil across the ocean. ETF.com reported that tanker shipping and energy-related ETFs surged in 2026 as oil routes were disrupted and freight rates spiked. Amplify, the issuer, describes BWET as a pure play on crude oil tanker freight futures. In other words, this is not broad market investing. This is niche, tactical, and very spicy. DECO is the State Street Galaxy Digital Asset Ecosystem ETF. Commentary from Advisor Perspectives highlighted DECO as one of the top non-leveraged ETF performers in 2026, driven by renewed interest in digital asset infrastructure and related equities. This is not a sleepy dividend fund. This is a full-volume, high-volatility, innovation-heavy theme. USO and UGA are both futures-based commodity funds. USO tracks crude oil futures exposure, while UGA is tied to gasoline futures. When energy prices jump, these funds can rip higher fast. They can also humble investors just as fast when the trend reverses. ETF.com and US News both flagged energy disruption as a major driver behind the strongest ETF gains in 2026. PTF is the Invesco Dorsey Wright Technology Momentum ETF. Momentum strategies buy what is already working, which can be wonderful in strong uptrends and deeply annoying when leadership changes overnight. Advisor Perspectives noted PTF's strong 2026 gains as tech leadership accelerated. But here is where most people get this wrong. They see a return number, assume it equals a great long-term investment, and then buy the ETF, without understanding what engine is actually under the hood. That is like choosing a vehicle because it won a drag race, then acting surprised when it is terrible for grocery runs, road trips, and parallel parking. Let's separate these 5 ETFs into 3 buckets. First, BWET. USO and UGA are tactical, event-driven, futures-oriented exposures. Second, DECO is a high beta thematic equity fund linked to the digital asset ecosystem. Third, PTF is a systematic momentum strategy focused on technology leadership. Same ETF wrapper, very different beasts. Bucket 1 is where the fireworks live. BWET is the most extreme example. A 411% gain can happen when a fund is tied to a narrow market with a supply shock. According to Amplify, BWET holds tanker freight futures with concentrated exposure to key crude transport routes. That concentration is exactly why returns can be explosive. It is also why risk can be explosive. A fund built around a tiny slice of the global shipping chain can soar when rates spike, but it can also fall hard when freight markets normalize. That is a trade, not a forever cuddle buddy. USO and UGA have a different wrinkle. Futures-based commodity ETFs may not behave exactly like the spot price you see on TV. Rolling futures contracts can create drag or benefit depending on the shape of the futures curve. ETF.com specifically warned that futures-based energy products can behave very differently over time than equity-based energy funds, and noted that for long-term investors, energy stock ETFs may be preferable to some futures-based products because of role-related issues. Translation: if you think, oil is up, therefore I am safe, your portfolio may file a formal complaint. Bucket 2 is DECO, which rides the digital asset ecosystem. This means you are not just betting on a single coin or token. You are betting on the broader business complex around digital assets, including infrastructure, platforms, and related companies. That can provide diversified exposure within the theme, but it is still theme risk. If sentiment cools, regulations tighten, or capital rotates, these funds can move with shocking speed. Strong upside comes with the emotional stability of a raccoon on a trampoline. Bucket 3 is PTF, the momentum entry. Momentum is one of those strategies that feels brilliant when it works and suspiciously magical when it really works. The logic is simple. Stocks showing strong relative strength can keep outperforming for a period. The catch is that momentum leadership can reverse quickly, especially if earnings expectations shift or a macro headline hits the tech sector. So yes, momentum can be powerful. It can also hand you a lesson in humility faster than a bad karaoke choice. Now let's zoom out. The ETF industry itself is enormous and still growing rapidly. ETFGI reported global ETF assets reached a record $21.91 trillion at the end of April 2026, with iShares and Vanguard leading global market share. S&P Global also reported strong Q1 2026 ETF flows, with equity and fixed income ETFs gathering the bulk of inflows, while commodity ETFs also saw demand during the energy shock. In plain English, ETFs are the default toolkit for modern investors. But a giant ETF industry does not mean every ETF is built for every goal. Now here's the part nobody talks about. Sometimes the best performing ETF on a leaderboard is actually the worst possible first ETF for a real human trying to build durable wealth. Performance is exciting. Portfolio fit is what keeps you from making dramatic decisions at 11:47 p.m. on a Thursday. Here is the fix. Use a core and satellite approach. Put most of your long-term money in broad, low-cost, diversified ETFs. For illustration purposes, consider S&P 500 ETFs, like VOO, SPYM, and IVV, or a total stock market ETF like VTI. Then, if you want tactical exposure to hot themes like energy, digital assets, or tech momentum, keep that in a smaller satellite sleeve with position sizes you can emotionally and financially survive. Personally, my 4-fund core portfolio consists of a broad S&P 500 ETF, SPYM, a momentum ETF, SPMO, a dividend ETF, SCHD, and a satellite position in aerospace and defense ETF, PPA. Why does this framework make sense? Vanguard's ETF guidance emphasizes diversification, low costs, and matching investments to your goals and strategy. Vanguard also notes that ETFs can be used to build a fully diversified portfolio across stocks and bonds, which is exactly the opposite of putting your life savings into one niche winner because it had a great 6-month stretch. That may sound less exciting than a 411% chart, but boring often pays the bills. State Street's 2026 ETF Outlook says the wrapper is expanding into increasingly sophisticated strategies and asset classes, but also highlights the practical questions around product complexity and liquidity. That is a polite institutional way of saying, just because it exists does not mean it belongs in your core retirement plan. So, here is a practical model. If you are a long-term investor, think of your portfolio in layers. Layer 1 is your foundation, broadly diversified stock and bond ETFs. Layer 2 is your factor or style tilts, maybe growth, value, dividend, or momentum if that fits your plan. Layer 3 is your tactical sandbox, where funds like BWET, DECO, USO, UGA, or PTF might live in small doses if you fully understand the risk. Small doses means small enough that a nasty drawdown is disappointing, not life-altering. If you want a plain language rule, try this. Core money should help you sleep. Satellite money can keep things interesting. If your core money keeps you up at night, congratulations, you have accidentally turned investing into a haunted house. So what did we learn? First, the top-performing ETFs of 2026 include very different types of exposures. Tanker shipping futures with BWET, digital asset ecosystem stocks with DECO, crude oil through USO, gasoline through UGA, and technology momentum through PTF. Second, huge recent returns do not automatically make a fund appropriate for a long-term portfolio. Third, futures funds, thematic funds, and momentum strategies can all play a role, but they should usually play a supporting role, not the lead actor with unlimited screen time. The real win is not finding the hottest ETF after it has already exploded. The real win is building a portfolio you can stick with, understand, and rebalance with confidence. That is how serious wealth gets built. Slowly, consistently, and with far fewer panic snacks. Support the channel. If you find this video helpful, make sure to like, share, subscribe, and hit the notification button to help the channel grow and reach more investors who want to build smarter, calmer portfolios. Do you want a deeper dive? Get access to checklists, templates, real examples, ready-to-use AI prompts, and free AI agents from the Second Act Investor AI Advisory System. Grab your copy of AI Meets Finance, Investing in the Age of Artificial Intelligence. Available on Amazon. Link is in the description. If you want to see how this plays out in a real portfolio, watch the next video displayed on screen. It ties everything together, and it will help you see the difference between owning a few exciting ETFs and building an actual plan.